Welcome back. This week, we are going to be rethinking investment risk. What we do know is investment goals and timescales will influence your choices and the different types of risk that you are going to be taking. Whether you are investing with a goal in mind or simply saving for retirement, it's important to understand risk. And in particular, you need to understand your own attitude to risk, because at the end of the day, that's all that matters. If you understand the risks associated with investing and you know how much risk you are comfortable in taking, you can make informed decisions and improve your chances of achieving your goals overall. Risk is the possibility of losing some or all of your original investment. Often higher risk investments offer the chance of greater returns, but there's also more chance of losing your money. So bear that in mind when you are looking at investments with higher risks. Risk means different things to different people. How you feel about risk depends on your individual circumstances and even your personality. Your investment goals and timescales will also influence, as I said earlier, how much risk you are willing to take. What you come out with is your own risk profile. And I'll share with you a link in the notes where you can do that for yourself. You can invest directly in investments like shares, but a more popular way to invest is indirectly through an investment fund. This is where your money is pooled with other investors and spread across a variety of different investments. And this is done to reduce your risk. One of the main things that you need to consider is that there are different types of investments. None of us like taking risk with our savings, but the reality is there is no such thing as a no-risk investment. You're always taking on some risk when you invest, but the amount varies between different types of investments. As a general rule, the more risk you are prepared to take, then the greater the returns or losses you could stand to make. There are many different ways to access investment funds, such as through individual savings accounts or ISAs, workplace pensions, investment bonds, private pensions, or general investment accounts. And there are many more. You can also take different levels of risk for the different pots of money that you have. And that's quite a good way of doing things. So if you've got a longer term goal, then maybe you can take a higher level of risk than you have with a shorter term goal. And it's good to remember that money you place in secure deposits, such as savings accounts, risk losing money in real terms. This is because interest rate paid won't always keep up with inflation and rising prices. And especially at the moment, because inflation is running at a very high level, as we are all experiencing. On the other hand, index-linked investments that follow the rate of inflation don't always follow market interest rates. This means that if inflation falls, you could earn less in interest than you would have expected at the outset. Stock market investments might beat inflation and interest rates over time, but you also run the risk of prices being low at the time that you need to sell. This could result in a poor return, or if your prices are lower when you bought them, you will risk losing some of your money. You can't escape risk completely, but you can manage it by investing for the long term and in a range of different things, which is called diversification. And we'll cover that at another time. You can also look at paying money into investments on a regular basis rather than all in at one time. And this will help smooth out the highs and lows and cut the risk of making big losses. We also know this as pound cost averaging. When you do invest, you are exposed to different types of risks. So let's look at those different types of risks. The first being capital risk. That is, your investments can go down in value and you may not get back what you invested originally. Investing in the stock market is normally through shares or equities, either directly or via funds. The stock market will fluctuate every day in value, sometimes by large amounts, especially when there are worldwide events or crises such as the pandemic, financial crisis, and what we are currently seeing in Europe at the moment. You could lose some or all of your money depending on the company or companies you have bought, and other assets such as property and bonds can also fall in value. So don't be lulled into a false sense of security that property and bonds don't fall in value, because they do from time to time and everything goes in cycles. There's inflation risk. The purchasing power of your savings declines even if your investments increase in value. You may not be making money in real terms if the things that you want to buy with your money have increased in price faster than the investments have increased in value. Then there is also credit risk. Credit risk is the risk of not achieving a financial reward due to the borrower's failure to repay a loan or otherwise meet a contractual obligation. Credit risk is closely tied to the potential return of an investment, with the most notable being that the yields on bonds correlate strongly to the perceived credit risk. And what about liquidity risks? You may be unable to access your money when you want to, because liquidity can be a real risk if you hold assets such as property directly and also in the bond market, where the pool of people you want to buy and sell bonds can dry up, and it does happen. I've seen it many times. We are more familiar with the next one, which is currency risk. That is, you lose money due to the fluctuating exchange rates in the currency markets. And we see that just by buying, selling in currency when we go on holidays. And lastly, there's interest rate risk. Changes in interest rates affect your returns on your savings. Even with the fixed rates, the interest rates in the market may fall below or rise above fixed rates, affecting your returns relative to the rates elsewhere. Interest rate is also a particular risk for bondholders, which I've highlighted earlier. So in summary, all I wanted to share with you today is there are a number of risks that we all need to consider when investing your money. However, when you invest and diversify your portfolio correctly, then you can actually control or at least manage these risks in line with your attitude to risk. I underline that as being such an important factor, that you need to invest in line with your own attitude to risk and timescales, because I've seen so many people invest in way above the level of risk that they are comfortable with, and often they become a cropper. I hope you found that useful today. Let me know what other topics you want covered in the future. See you next time.